Hello, we're back again with Issues of the Day Weekend Intelligence Brief. I told you I would be back, but I didn't come back as quick as promised, but the weekend has passed. So this is Saturday to Sunday's 1st, 2nd August issue of the Weekend Intelligence Brief, which came out, and this is the visualized summary or the video edition of the print. So good morning, good evening, or good afternoon, and welcome to Issues of the Day, the Weekend Intelligence Brief from Frederick Cybersecurity. I'm Frederick Wakuliaka, founder of Frederick Cybersecurity, protecting medium enterprises in financial services, professional services, and healthcare. This is your strategic business intelligence for the weekend of the 1st and 2nd of August 2026. This is not a cybersecurity incident briefing. This is the edition where we step back from the week's technical noise and look at the regulatory changes, the economic conditions, and the policy developments that will shape how you run your organization over the months and years ahead. 3 major stories occurred this weekend. The Bank of England held rates and revealed a committee that is quietly fracturing over what comes next. A new Prime Minister named the hard choice on social care. A new levy on working age earners after spending his first 11 days on the cheap, visible wins. And 2 of the world's largest technology companies reported earnings on the same day in opposite directions, splitting a trade that markets have treated as one for the better part of a year. Read together, these are not 3 unrelated headlines. They are the shape of the next quarter for a medium enterprise, financing costs that are not falling as fast as hoped, a labor cost base that may be about to move, and a technology sector whose winners and losers are diverging in ways that will filter down into every vendor conversation you have. If you are watching on YouTube, please subscribe at Frederick Wakuliaka 4561. The full written edition is on LinkedIn. Let's go to the first story. The Bank of England, the committee is splitting underneath a hold. A central bank held rates this week and somehow made that the least reassuring outcome of the year. Thursday was the 30th of July. The Bank of England's Monetary Policy Committee voted 6-3 to hold bank rate at 3.75%. It's been held steady at 3.75% every weekend. I've been checking on the MPC rates. We've been reviewing the annual meetings and the last meetings and the previous meeting and the previous one. The Monetary Policy Committee has held it at 3.75%. On the surface, this was the least interesting possible outcome. Analysts had priced in a hold with high confidence, and bank rate has now sat at the same level for 5 consecutive meetings. On paper, that is boring. Look one layer down, and the story changes entirely. The number of committee members voting for an immediate quarter point rose to 3, up from 2 in June and 1 in April. That is a committee moving in one direction across 3 consecutive meetings. That is not noise, that is a trend. Governor Andrew Bailey's explanation is worth sitting with. Headline inflation fell faster than expected, down to 2.6% in June. Comfortably below where the bank's own forecast had put it. In an ordinary year, that is your green light to start cutting, except the bank's own forecast now shows inflation climbing back up to around 3.2% by the fourth quarter of this year, because energy prices are still elevated and volatile off the back of the Middle East conflict. The committee's own language was explicit. The risks to the inflation outlook are tilted to the upside. So the bank is not holding because it is confident, it is holding because it genuinely does not know which way to move next, and it wants both options, a cut and a rise, available on the table. For a medium enterprise, the business impact sits in three places before it sits in the interest rate line of the balance sheet. First, borrowing costs. The bank's own policy summary noted that mortgage rates and the cost of borrowing for firms are already running higher than they were before the Middle East conflict began, and that this is measurably making households and businesses more cautious about spending. If you are carrying variable rate facilities, an overdraft, or asset finance due for renewal this autumn, price in the possibility that the next move is up rather than down. The market pricing that assumed cuts later this year has been pushed back. The swaps market is now pricing in increases rather than reductions before year end. Have that conversation with your lender now, not when the renewal date arrives. Second, customer side caution. If borrowing costs are constraining household and business spending more broadly, that shows up first in sales pipelines for anyone selling into discretionary or postponable categories. Capital, equipment, non-essential professional services, elective healthcare spend, before it shows up anywhere else. If your pipeline has felt softer than your underlying activity would predict, this is part of the explanation. Third, and this is the one worth sitting with, currency and energy pass-through. Sterling ticked up marginally against the dollar immediately after the decision, a modest vote of confidence in the bank's credibility rather than a signal of underlying strength. But the wider picture is that energy costs remain the dominant swing factor in the inflation outlook. Business with meaningful energy exposure, manufacturing, logistics, healthcare facilities, running continuous equipment is more exposed to a scenario where the bank's upside inflation risk materializes than one with a services-only cost base. And it is not only the UK. The United States Federal Reserve held the day before Wednesday, the 29th, in a 9-3 vote, with three regional presidents pushing for a hike of their own. Two of the world's most closely watched central banks, same pattern, same week. Hold on the surface, but a hawkish minority that keeps growing underneath. That tells you something the consensus commentary is not fully pricing in yet. The professional forecasting community on both sides of the Atlantic sees more inflation risk ahead than most of the business press currently reflects. There is a quieter mechanism running alongside the headline rate decision that deserves attention from any business with meaningful cash balances or debt service obligations quantitative tightening. The bank is continuing to run down the size of its asset purchase program, reducing its holdings from a peak of £895 billion towards a target of £492 billion. This program sits outside the headline rate decision and rarely makes the news, but it has a direct effect on the supply of longer-dated government debt in the market, which in turn shapes the pricing of longer-term fixed borrowing more than the headline bank rate does on its own. A business locking in a 5-year fixed facility this autumn is being priced off a market, absorbing both a cautious central bank and an active seller of government bonds simultaneously. Ask your lender directly how much of any quoted rate reflects gilt market conditions versus bank rate itself. They are not the same thing, and right now, both are pushing the same direction. There is also a labor market angle buried in the bank's own reasoning worth flagging. The committee is banking on a looser labor market more slack than a year ago to help cool wage growth alongside the higher borrowing costs everyone is already facing. Good news on pay review planning. It points to continued softness in wage inflation pressure through the second half of the year. Less good news as a signal. It means the bank's whole strategy depends on demand staying subdued rather than bouncing back. The committee is not expecting a strong recovery before the next full forecast round in November. The board action here is specific. If you have a facility renewal, overdraft review, or asset finance decision scheduled before the bank's next meeting on the 17th of September, have the conversation with your lender now on the assumption that the next rate move is more likely to be up than down, rather than waiting for the renewal date and taking whatever is offered. That's the best advice I can give you for now. Story 2, social care funding. The hard choice gets a number. 2 weeks ago, this brief covered the visible low-cost opening moves of the Burnham government, VAT cut on electricity, the £2 bus fare, the symbolic Manchester policy hub inside Number 10's structure, cheap, immediate, popular. The kind of announcements a new government makes before they land, the kind of announcements a new government makes because they land in a household budget this winter rather than in a select committee report in 2029. This week, the harder conversation started, and it is the one that actually matters to a medium enterprise's cost base. Speaking from a care center in North London, the Prime Minister told reporters that difficult decisions would be required to fund a genuine overhaul of adult social care. He indicated he wants the system built on what he called an NHS principle of collective contribution, language that signals new ring-fenced funding stream rather than reallocated existing spending. He asked opposition leaders to engage in cross-party talks and confirmed that the independent review into social care reform, led by Baroness Louise Casey, will now be published earlier than originally planned. The specific number that has emerged, and I want to be clear, this is not confirmed policy yet, is a levy of 1.8% on earnings above £6,240, payable by workers over the age of 34. One assessment this week put the broader package at £30 to £40 billion in new spending on defense, housing, and social care combined. Funded through 20 to 25 billion in tax rises, additional borrowing, with an explicit warning that the bond market is already close to the limits of how much extra borrowing it will tolerate. The last point matters as much as the levy number itself. If genuine fiscal headroom for borrowing is constrained, the balance of any funding package tilts further towards taxation, which increases, not decreases, the likelihood that a business facing or payroll facing levy features in the eventual proposal. For medium enterprises across financial services, professional services, and healthcare, the direct impact runs in two directions. The direct one is straightforward, a levy on employee earnings. However, it is finally structured, changes the cost of every worker over the age of 34 on your payroll, and changes it in a way that is very difficult to pass through cleanly to clients in professional and financial services, where fee structures tend to be set well in advance and pricing power over existing engagements is limited. If you employ a workforce skewed towards more experienced, higher earning staff, which describes much of financial services and senior professional services, you are more exposed to an age-banded levy of this design than a business built around graduate intake and internal progression. The indirect impact cuts the other way for healthcare providers. Any genuine increase in social care funding is in the medium term additional demand and additional commissioning activity for private healthcare providers, care operators, and the professional services firms, accountants, lawyers, consultants who serve that sector. A social care funding settlement that resolves years of structural underfunding is not unambiguously bad news for every reader of this brief. It depends entirely on which side of the funding versus spending equation your business sits on. There is a governance dimension worth watching, separately from the fiscal one. Whether Kemi Badenoch and the Conservative opposition actually engage substantively with the cross-party offer or treat it as a trap, a funding settlement built with opposition buy-in is more durable than one imposed on a party line vote, because it is far less likely to be unwound at the next change of government, a meaningful consideration for any business trying to make a multi-year workforce cost projection. Watch what happens in the coming fortnight. Badenoch's response will tell you more about whether this becomes a stable planning around cost or a political football rewritten every 18 months than anything in the levy design itself. The choice of an NHS-style collective contribution model is itself a signal worth reading closely. A broad-based universal levy is politically much harder to unwind once introduced, because reversing it means either a visible service cut or a visible replacement funding gap. If this design principle carries through into the formal proposal, businesses should treat any resulting levy as a structural, multi-year addition to payroll cost, closer in character to employer national insurance, which has proven durable across multiple governments, than to a discretionary surcharge likely to be quietly dropped at the next fiscal event. There is also a competitive dimension for professional and financial services firms specifically. A levy structured around age bands rather than income bands alone changes the relative cost of experienced senior hires in a way that flat payroll taxes do not. Firms that have grown through experienced lateral hires, common across financial and professional services in the current market, would see a proportionally larger increase in effective payroll cost than firms built around graduate intake and internal progression. This is worth feeding into hiring mix decisions being made now for roles that will not start until the second half of next year. well after any levy would take effect. The board action here, if for the board of directors, if your payroll is weighted towards senior higher earning staff over the age of 34, build a scenario now for an employee side social care levy in the region of 1 to 2% on earnings above approximately £6,000. The proposal is not formal. You do not need to act on it yet, but having the model ready means you are adjusting a number rather than building a forecast from nothing when the KC review lands. Story 3, Microsoft and Meta, the AI trade splits. For the past several months, markets have effectively treated AI capital expenditure as a single trade, broadly bullish on companies spending heavily on AI infrastructure, broadly punishing any sign that the spending was not translating into revenue. This week's earnings from two of the largest players in that trade delivered a genuinely new development. The trade split. Microsoft reported quarterly revenue of $90 billion, 90.01 billion ahead of the 87.62 billion analysts had expected, with profit up sharply. The standout number was Azure, Microsoft's cloud division, and the primary vehicle for its AI infrastructure spend, which grew 43% at constant currency against a street estimate of 40.2%. Microsoft confirmed Azure had generated more than $100 billion of revenue across the full 2026 fiscal year, the first time the division has passed that threshold. This is a company whose AI-linked capital spending is now visibly converting into revenue growth that beats already elevated expectations. Bravo, Microsoft. Meta, on the other hand, told the opposite story on the same set of days. Revenue grew 28% to $60.8 billion, a strong headline number, but second quarter profit fell 14% to $15.9 billion, with earnings per share of $6.18, missing consensus estimates by more than $1. Meta's guidance for the third quarter came in with its lower end below what the street had expected. Shares fell around 10% in after-hours trading. Shares fell around 10% in after-hours trading, a materially larger single-day reaction than the headline revenue number alone would explain. That reaction is the signal the market has stopped rewarding AI spending as a category and started demanding company-by-company evidence of return. Samsung Electronics, reporting separately, posted an 1,814% year-on-year increase in second quarter operating profit. Understanding that the divergence is not a simple large technology company story, it is running company by company based on where in the AI supply chain each business sits. Samsung's number is coming from memory chip pricing and demand tied to the physical infrastructure build out behind AI data centers. That is the hardware layer, not software at all. For a medium enterprise, the business impact is not about your own share price. Most readers of this brief are not publicly traded. It is about the vendor relationships and technology procurement decisions this divergence will shape over the coming 2 quarters. Let's continue. The underlying model distinction matters directly for how you treat vendor risk. Microsoft's AI spending flows primarily through Azure, and infrastructure business selling compute and platform services to enterprise customers on contracted recurring terms. When that spending converts into revenue, as it clearly did this quarter, it converts into predictable forward visible revenue that supports continued investment. Meta's AI spending flows primarily through advertising products and consumer-facing features, where revenue depends on user engagement and advertiser demand that can shift quarter to quarter in ways a fixed enterprise contract does not. That distinction is a genuine diligence signal for any vendor evaluation you are running this autumn. A vendor whose AI spend converts predictably through enterprise infrastructure contracts is a more stable long-term contracting partner than a consumer platform vendor whose AI spend depends on advertising demand holding up, even if both are described in the market as AI companies. If your technology stack includes AI features bundled into consumer-facing platforms rather than dedicated enterprise infrastructure contracts, the Meta result this week is the more directly relevant signal for how durable that pricing and feature set is likely to be. Build shorter renewal cycles and clearer service level protections into any new agreements so that a sudden strategic pivot on the vendor's side does not leave your business exposed mid-contract. A word on Samsung specifically, because it sits outside the software and services framing that dominates most AI capital expenditure coverage. An 1,800% increase in operating profit reflects physical hardware demand tied to AI data center build out. For any medium enterprise procuring physical infrastructure, whether directly through on-premises hardware refreshes or indirectly through a hosting or colocation provider's own cost base, this is a reminder that the AI capital cycle is running through the hardware supply chain as forcefully as it is running through cloud services. Hardware adjacent costs are as exposed to this cycle as software subscription costs are. Do not assume they are insulated. The board action, if you are mid-negotiation on any AI-enabled software or cloud contract with a vendor whose parent company reported this week, revisit the earnings commentary before you sign. Where a vendor sits on the infrastructure end of the spectrum, recurring enterprise contracts, revenue converting cleanly, treat multi-year commitments as comparatively lower risk. Where a vendor's AI features are bundled into a consumer-facing or advertising-funded platform, build shorter renewal cycles and clearer service level protection into any agreement before the renewal date arrives. Okay, The thread now. Each of these three stories read in isolation looks like a specialist concern: monetary policy, fiscal policy, technology sector earnings. Read together, they describe a single underlying condition. The assumptions that have underpinned business planning for the past year are being actively retested in real time on multiple fronts at once, rather than settling into a new stable baseline. The Bank of England is not confidently signaling a direction. It is holding a position while a hawkish minority grows underneath, which means the direction of travel is less certain than it was in June, not more. The government is not quietly funding social care through existing budgets. It is naming the fact that new revenue will be required, which converts a long-standing structural funding gap into a near-term cost planning question for any business with an age-skewed senior payroll. And markets are not rewarding AI investment as a uniform category anymore. They are demanding company-specific evidence of return, which means the vendor landscape, a medium enterprise, is buying from this autumn is less predictable, not more than it was in the spring. None of these three developments is individually a crisis. Together, they are a signal that the second half of 2026 will reward businesses that build financing, workforce costs, and vendor selection decisions around ranges and contingencies rather than around a single confident forecast. There is a timing dimension worth making explicit. All three threads share a common feature. Each has a scheduled checkpoint later this year at which the current uncertainty rather resolves or deepens. The Bank of England's next full forecast round lands the 5th of November. The KC Review's earlier publication, if confirmed, is likely in the autumn. Ahead of any formal legislative proposal, Meta's third quarter results, the next real test of whether this week's guidance miss was a single quarter's wobble, are due in the same broad window. Build one internal timeline spanning September through November that maps all three checkpoints against your own financing, hiring, and vendor contract renewal dates. A bank decision, a fiscal announcement, and an earnings result visible in a single view against your own commitments, not reacted to as individual surprises when they land. Three decisions before Monday. First, if you have a facility renewal, overdraft review, or asset finance decision before the bank's next meeting on the 17th of September, have that conversation with your lender now on the assumption that the next rate move is up rather than down. Do not wait for the renewal date to arrive and take whatever is offered. Second, if your payroll skews senior build, the social care levy scenario now 1 to 2% on earnings above roughly £6,000. Nothing to act on yet. The proposal is not formal, but have the model ready so you are adjusting a number rather than building a forecast from nothing when the KC review publishes. Third, if you are mid-negotiation on any AI-enabled software or cloud contract, check where the vendor sits in the earnings spectrum before you sign. Infrastructure side, converting cleanly, lower risk on a multi-year deal. Consumer platform side, running on advertising, economics, shorter terms, better service level protections before you commit. That is the intelligence picture for the weekend of the 1st and 2nd of August 2026. Three stories, three decisions your organization needs to make before Monday morning or this Monday morning. Financial costs are not falling as fast as hoped. A labor cost shift may be coming, and the AI vendor landscape is diverging in ways that will reach your renewal conversations this autumn, whether you are tracking them or not. The next AI breach report returns Wednesday with fresh incident intelligence from the week that just closed. The Bank of England's next decision lands the 17th of September. Watch for the Casey Review's confirmed publication date and watch Meta's third quarter results. That is the real test of whether this week's earnings split was a single quarter's wobble or the start of something larger. I'm Frederick Wakuliaka. This has been Issues of the Day, the weekend intelligence brief from Frederick Cybersecurity. The AI Breach Report publishes every Wednesday and Friday on LinkedIn. Subscribe to my YouTube channel, Frederick at Frederick Wakuliaka 4561. Thank you for listening, and I'll see you again